Hello, sauti imepotea.
You explain and say this is a transaction-based system. This is a transaction-based system where stock records are maintained, as per transaction. This is a transaction-based system where stock records are maintained as per transaction. Maintained as per transaction. Then the second point, you say each purchase or issue of the stock, is recorded. Each purchase or issue of the stock is recorded, and therefore the stock balance are readily available. At any given time. Say this will address the problem. Of under or over stocking. This will address the problem of under or over stocking. Under or over stocking. Then you can put another point, say the following methods are used. To maintain stock record for valuation. The following methods are used. To maintain record of stock for valuation. Leave the record stock of valuation. The first method we have, can list them. We have first in, first out. In private people, I hope the share skills are easy. Then number 2, have last in, first out. In private level. Then we have number 3. Number 3 is a weighted average method. Weighted average method. Weighted average method. Number 4, we have simple average method. Simple average method. Number 5, standard price method. Standard price method. Then we have the last one, number 6, highest in first method. Highest in first out method. I hope sauti iko sawa ama bado iko chini? So we can start with the first one, first in, first out method. That is FIFO. First in, first out method. So this first in, first out method is that the first product you receive will be the first one you issue. So this one, I think it will minimize the wastage of the product because but now this one will not apply to perishable goods. So you can say this is the method of stock valuation. So explain what detail. This is a method of stock valuation. This is a method of stock valuation in which the item received first, in the store, which the first item received first in the store is issued first from the store, in case of a sales, is issued first in the store in case of over sales. So you issue first in case there is any sales, you issue first. The second point, say this method is normally used. This method is normally used where the inventory. This method is normally used where the inventory is highly perishable. Where the is normally used where the inventory is highly perishable. In nature. Is highly perishable in nature. The second point to say this method is applicable in all organizations. This method is applicable in all organizations where continuous stroke perpetual, stock taking exists. This method is applicable in all organizations where continuous stroke perpetual stock taking exists. Put another point saying when issuing the first batch of the unit, when issuing the first batch of the unit, should be exhausted in order to issue goods from the second. Is exhausted first in order to issue goods from the second received batch. Then another point to say, in case of a closing, in case of a closing stock, from the previous period, in case of closing stock from the previous period, say that closing stock will be the opening stock for the current period. Hence, the first batch in our stores, the first batch in our store, which should then be issued first. So we say anything which you are receiving are first will be issued first. So you can have the format, the small format here, before you will prepare this as store card. So they normally call a store card or a store ledger card. So you will have the date. After that, you have the unit, and then you have the cost per unit. This one is cost per unit. C stroke I. So this part, and then we have the value. So you will be having two parts. You will be having two parts. The first part is the receipt. So this part is the receipt you are receiving, and then we have another part which is what? Issue. So also you will have date. You have date. Which necessarily we receive the no. There is no need of date. You have unit. Also, you have the value, the cost per unit. Then you have value, cost per unit. Then you have value. Then we will have the units and balances. So in receipt, in issue, that we have balance here. Balance. So balance will have units and value. So make sure you get that that format. So if each time they ask you to prepare a store ledger card, you have to prepare a store ledger card like that. That is the receipt. You are receiving goods into store, you are issuing or selling, and then you will remain with balance. You will remain with balance. Have look at our past paper, not seen illustrations. There is an illustration for November 2010. So if you get those old past papers, those are good. So you can check for November 2010. There is a question number 3, which is for a FIFA. But in our current past paper, we only have one level here. So there's so we don't know. They are testing this. So we have one of November 2015. One for November 2015, that is for FIFA. November 2015, question 3. So we can look at this. Illustration. So the question read, umepata past paper? Ama una link?
Niko na past paper.
Umepata swali November 2015.
Question
3B.
nimepata question 3B. Canisters.
Yes, canister. So the question read, canister provide the following information in respect of the operation for the month of July 2015. So we have the receipts and the issue, it dates, and the date issue. Additional information, that is a material in store as at that yet June 2015 was that one. That is the opening stock. Then on 1st July 2015, part of the material issued on 1st July amounted to that one was returned. Okay. That's note number 3. Only on 15th July 2015, 100 units were returned to Kenya store. Then another one, number 4. On 21st July 2015, there was a material wastage of 5,500 units. And then return from the June 2015 issue of 100 units at 45 shilling was received on 25 July 2015. Then number 6, on 28 July 2015, there was a shortage stock of 20 units. Then Kenner Store uses the first in, first out method to value its inventory. Required a store ledger card for Kenner stores for the month of July 2015 is 14 months. So you will have to update. So we have a receipt. We have date. We have a unit, cost by unit, and then we have value. Then we have issue. We have unit, cost by unit. We have value. Then we have balance here. We have unit, and we have balance here for values. Or values. So that's how your store ledger card look like. So mind, yes, if I roll this board, it will look more squeeze. So utarol kwa kitabu yako. So they have told us material in store as at first was valued this. So on first, so we are preparing a store ledger card for a period of July 2015. So you will have 28 date here, 1st July. So you can write a July 1st. July 1st, we add how number of units to receive number of units gapi. They are given as 2,000. They are given as 2,000. That is the opening balances. Ukiangalia note number 1, tumetuambia material in store as at 30th June 2015 were 2,000 at a unit cost of what? 50. So the unit price is for 50. So what will be the value? So the value of this, it is on opening balance. It is opening balance. So you will print this on first. No, on first we didn't receive. Sorry. So don't put it here. On first we didn't receive. So we add these 2,000 units. This 2,000 units at what? At 50. And the cost price of this was 50. So you get this one times this one. Ngapi the value. 50 times 20. 50 times 20 is 100. Yes. So we have the 100 as our opening stock, 100,000 on 1st July. Then we go to the second date. Our second date is 3rd July. So we have July. You can write July here without this here instead of repeating July. So on 3rd July, we receive 60 units, 600 units, and then at the price of what? The cost is 60. So what will be the value? So multiply this one. That is 360. That's 6,000. So this 36,000, we have received this 36,000. Then you take this unit plus this one so that you get, that's why you get the accumulated unit. So it will be this one plus the previous unit, which is 2,000. So here we'll have 2,600. Then the value also, you accumulate the value. So it will be that 6,000 plus this one, which will come to 136,000. Not correct. I think it is that one. 100. Yes, 136. Then the most recent time is 5th of July. The 5th of July, what happened? We issued 1,600 units. So here we issued 1,600 units. Now the question is, We will issue this 1600 unit at what cost? We will issue that 1600 unit at what cost? Taishu na cost gani? Reason is we are using V4 first in, first out. So this 1600 unit we are issuing, we are issuing the first unit which we receive, which is what? 2000. So we will issue it with associated cost of that unit. The cost per unit. Hii ya kwanza. So tuta issue na ngapi? 50.
2000.
Ana. The 2000 was the unit.
50.
Yes, that the unit cost is for 50. So tuta issue na 50. So this one times this one tutakuja ngapi? 1600.
1 million.
What?
No, it comes to
Ni
100,000.
16 times 50 times 16 is 80,000.
100,000.
No, this part, I want to get this part alone. 1600 times 50 inakuja ngapi? 80,000. No. Then from that, this one to make issue. So if you issue, you reduce the balance. You reduce the balance. So it will be 80,000 minus 136. So it will be 136 minus
Inakuja.
56. No.
Yes.
So here we have 56,000 as our balance. Then we go to the second date, which is date 7. Date 7, there was 1,000 unit they received. So they received 1,000 unit at the cost price of what? 70. So the total value will be 70,000. So we add this 70, you accumulate the unit. Now, remember when you issue 1,600 units, we are remaining with how many units here? 1,000. No. So here we remain with 1,000 for the issue. Then you see my board haiko straight. So kwa kitabu I know it is a line imetali vizuri. So here we receive 1,000, which we increase this one. So the value here of the unit will be 2,000. Then the value of the cost will also increase by 70. So it will be 70,000 plus 56,000 plus 56,000, which is
126,000.
126,000. Then we go to note number 9. Date 9, sorry. Date 9 iko kwa note number 2. On 9th July 2015, part of the material issued on 1st 15th July, 5th July amounting to 200 were returned. So on July ilikuwa returned, but now tumepata an information that the good has been dispatched. Mahali tulikuwa tumeuza, but we have not received. So in accounting, you don't account for anything that you have not seen. So at least you get the document, you confirm those documents, you see now it is the returns of good debt, you can't what? Account. That's why that note, they will give us that note in the. No, this one is a different with note number 6. So on 1st July, part of the material issued on 5th July amounted to 200 were returned. Okay, so there is a return. So if it is a return, then we assume as a receipt because we have to adjust our stock back. So itakuwa umereceive hizi stock na ngapi? 2,000. Juu already tulikuwa tumeissue hapa 1,600, but tukaambiwa hii 1,600, 200 is not valid or it is not up to standard, then they return back. So we receive here 200. Then at which price? So tuta receive at the cost yenye issue, si ndio? We issue this cost at 50. So we will not receive at another price. No, we have to receive at the same price. So itakuwa 50. So if you multiply this one, it comes to 10,000. Okay. Yes. So 10,000, we add back this 2,000 here, and also we add back the value. So the cost here will be this one will be 2,200. Then the value here will be 36,000. So that is the note number 9. Then which is the second date. After date 9, tunaenda date what? Tuna date 12. Na date 12. Date 12 tukafanya nini? Tuka issue for 400 units. 400 units. So in this 400 units, unaangalia, are we exhausted the first batch or we receive, or we add in the opening balances? Mesha exhaust.
Yes. No, we have not exhausted.
We are remaining nangapi?
200. 200.
Question is 200. So unaangalia, the first one tulikuwa na 2,000, sindio?
Yes.
Tuka issue 1,600, sindio? Tukabaki na ngapi?
400.
And then tukarudishiwa ngapi?
200.
So at the in hand already tuko na ngapi?
600.
600. So bado hatuja exhaust. So now these 400 we will fully utilize from the opening balance. So we will issue again at the same cost ya ngapi?
50.
50. So that one itakuja so
20,000.
400 here. So hii inakuja 20,000.
20,000, yes.
Then you less this unit from this one, remain at 1,800.
Yes.
Then 20,000 minus this one will remain with 116.
16,000.
Then we go to this another date inafuata 12 15. 15 tumeambiwa on July 15, 100 unit were returned to Kenya store. Then this one, it was received on 25th July of 2015. So we will not account that one because we have been told that this one was returned, but they received on 25th. So this one, it is the same like if you are an accounting for a direct deposit. The customer has made a direct deposit to the bank. So the bank will debit on that date, but you don't have the information. So until you access the bank statement so that you know this amount was deposited into our account, then you will have the date of a deposit and the time of receipt. So that's what they are telling us here. So ukipata that information, it will not affect us. We will adjust on that date. Then we go to the most recent date, date 18. So tuko na receipt of date 18. Date 18. Receive ngapi? 2,400. 2,400 to receive at 80. So 24 times 8. That now these values will be very big. 24,080. 192,000. So we increase the number of units.